Welcome to TheoTrade. This is Don Kaufman. It's October 31st, 2025. About an hour to go to the cash close here on this Friday afternoon. The S&P's trading higher, but there's a lot more going on inside of this marketplace. First, happy Halloween, everybody. Let's get right into it here on this TheoTrade weekend update. So I was saying a moment ago, the S&Ps, they're looking pretty good. I mean, today, they're up some 27 points. And, you start to dig into the entire week. If you're looking purely at the S&Ps, where are we right now? You're about halfway home to the upper edge of the expected move. We had hit the upper edge of the expected move, which was, that's about 110 points higher on the week. We reverted back down, obviously, on Thursday, a little bit of a bounce today. And net, what are we, like 50, 60 points higher right now? In terms of SPX, we're 50, 60 points higher on the week. But when I say there's a lot more going on over here, that's because most market sectors, they're getting smoked right now. Let me dig into that. Let's just get right to it here. The sectors that are getting smoked, the QQQ, well, I'll tell you right now, the Qs are the only thing that are holding this marketplace together. But from a sector point of view, you'd want to look, more than just QQQ, which is just, the NASDAQ in general. You'd want to look at like SMH. Take a look at SMH. Here you go. This is the semis, okay? Break into the upside. The other one that's actually positive, okay, is XLK. Also, this is like technology select. This is outside the upper edge of the expected move. Now, I'm telling you a second ago, like, oh, sectors are getting smoked. Yeah, well, guess what? I started with the two sectors that are absolutely spectacular. And of course, okay, if you're kind of newer to this business, you'd tell me, those are the only sectors that even matter, man. It's not even sectors. Let's not even talk about sectors anymore, because the XLK or the semis, that crap is owned. It's owned by NVIDIA, okay? It's owned by Google, which broke to the upside in its earnings, okay? Amazon, which is almost a 2 standard deviation move. It had a $15 expected move, hit 30 this morning. It's reverted back a little bit. But the marketplace is owned by these sectors. Tesla, okay? Tesla on the week, okay, it's not spectacular. It's only the upper edge of the expected move. But net, it's all you got in this marketplace. And I really mean that. That's like all you've got. Why? Let's start with the Russell. Okay. I mean, the Russell is an entire, indice. It's not necessarily a sector, but I'm calling the small caps a sector today. Why? Because they're small. Who's going to argue? They're small. Anyway, the IWM here is sitting right near the lower edge of its expected move. Quite frankly, some of the sectors I'm about to show you, that's actually one of the better performing ones. Next, we're going to come to the XLU. This is actually the utility sector. Utility sector, now I had a position in here. My position actually closed out profitably. So the XLU is well outside the lower edge of the expected move. And again, let's just kind of continue on down. All right, not too many people know this, but XLB, which is the materials sector, okay, this thing is an absolute shocking, almost 3 standard deviation move outside, okay? It's between 2.5, 2.8 standard deviations. I mean, we're talking big boy movement, okay, in the XLB. Materials sector is getting absolutely smoked. Then we're going to come to the XLV, which is, of course, healthcare. Healthcare, where are we at? Lower edge of the expected move. Kind of coming back up a little bit today on an intraday basis. Quite interesting. It did actually rally a little bit on an intraday basis, but XLV off pretty big. Then, okay, where to go from there? Let's go to the financials. XLF, okay, the financials, where are they? Lower edge of the expected move. Ironically, we're like trying to rotate back into the financials today. We're trying to rotate back into healthcare. Turns out they're just crap. It doesn't even make a difference, but we're carrying lower edge of the expected move. Then you're going to love this one, okay? What are we at over here? Holy crap. That's one of the biggest moves actually on the week, okay? In terms of stuff that matters. What is this? It's XLP. It's the consumer staples, okay? And they got rocked this week. Huge 2 standard deviation move. So by Wednesday, this thing it's all over but the crying. And it's amazing because the divergence between the XLP and, for example, like, SPX, if you look at SPX breaking to the upside of the expected move on Wednesday, meanwhile, the XLP, okay, is actually breaking massively through the lower edge of it. And then, of course, I'll actually end up here with the XLE, a little anticlimactic, but the XLE, which is the energy sector, is flat. The other retail sector, XRT, is also getting hit. I figured I wasn't going to cover this, but I'll actually pull up XRT because it does make a difference. So net, what do you have here? Well, you got one sector that's flat, okay? Obviously, you have, the semiconductors up, technology select that's up. Everything else is pretty much getting decimated across the board. There's not a lot of good stories out there. We can even look at like XHB, start getting into home builders, okay? Home builders also, okay? This is a huge move outside the lower edge of expected. And I wanted to start with that because net, what does it mean? You're going to be, well, the S&Ps continue higher. The market internals, they absolutely suck. The market breadth, it's terrible, okay? And at the exact same time I'm saying that, if you want to see some record-breaking stuff, you have to recognize you have the marketplace basically at an all-time high with internals, okay, that are terrible. In fact, that is the record that was broken earlier this week. Is nobody's ever seen, like on Wednesday, it was an all-time high with market internals that were absolutely terrible. That's one of the biggest takeaways of the entire week. So the belly of the beast, okay, is rotten over here, but everybody's like, well, as long as AI sustains us, we're going to be just fine, man. We're just going to be fine. And, the more you say that, the more sarcastic it actually sounds. This next week of trade, again, is going to be fairly pivotal. This one was fairly pivotal, okay? And we continue, on this very theme. And you're like, what's so pivotal about it? Because this internals, they keep getting worse. Like, last week I was talking about volatility. In fact, I'm going to talk about volatility in a second here. I was talking about volatility last week and how pivotal it was. Like, volatility continues to see, okay, and scream that pain is ahead. And just people are not necessarily seeing it. And normally I wouldn't make such a big deal of it, right? Where volatility sees pain ahead, but volatility sees pain and yet you're at an all-time high. But now, so that was last week. I could see that volatility was elevated and that there's a problem. Now we have volatility continuing to elevate, and you have really, really crappy sectors all over the place. So what I think we're going to see this next week in trade is an attempt at the rotation game, meaning that I think markets could sell off this next week, but they're not just going to sell off. They're going to basically try to rotate like back into financials. Rotate! Try to save it by rotating back into financials. Or like you're already seeing a little bit today, we're rotating towards like the energy sector. There's some news on energy sector, but nothing too crazy. They're trying to rotate back to some of the sectors. I would assume that even like XLP, okay, this may have a little bit of a bullish tone to it next week. No one has wanted to touch, okay, the consumer staples at all. And this actually does have some politics behind it. Okay, it definitely has, people are going to say it's like the snap and so forth. And I get it. Like, I agree, but it doesn't matter. I think we're going to start rotating, out of places like Meta and continue to rotate out of places like Google and a few other of the, the semis and maybe even NVIDIA. See a rotation out of NVIDIA, and they're going to try to fly back into financials. They're going to try to move into, the XLP, which is consumer staples. They're going to move towards places like healthcare. Okay, take a look again at XLV. And then, normally I just talk about like volatility, but I'm telling you, the volatility already seems to see this, right? That we're going to see some rotations. But the volatility doesn't seem to buy that theme, which means we're going to attempt to rotate and then maybe kind of get pulled down in it, right? There's just not much, okay, holding this marketplace up right now. And as I said a moment ago, volatility, it still screams that pain is ahead. Where the hell do you see that? I know everybody wants to look at the VIX, okay? But you know what? Sure, what the hell? Let's pull up the VIX, okay? Let's pull up the VIX, okay? Everybody agrees, right? Market goes down, VIX goes up. Market goes down, VIX goes up. Yeah, well, this week the market's up. Where's the VIX? Up. Yeah, how do you like that? Okay, you're getting upside volatility, which is, I look more at the volatility futures. The volatility futures, okay, they're lifting. All right, so they're lifting out there. You can look at VVIX. Some people like to talk about VVIX. And again, let's not get crazy, but the VVIX is crazy right now. Okay, and the VVIX is like, how many up days does it take? This is volatility of VIX, which just basically says like crap's going to get real out there, to make the VVIX go up. This is the big takeaway whenever I talk about VVIX. To make the VVIX go higher, you got to buy calls, okay, in VIX, like kind of fiercely buy calls in VIX. So why does trade buy calls in VIX? One of two reasons. They're buying calls in VIX, okay, because they either think the market's going down or they're hedging because the market might go down. But the calls that they're buying have to be, okay, the VVIX is measuring 30-day volatility. So it's either these 18 days, okay, 18-day vol, or they're buying 46-day vol. Those kind of average together in there. And we are seeing quite a bit of activity in here. Like, look, 7,000 here, okay, but that pales in comparison. You really start to open up. You have to open up the full option chain to see. Like, it always makes you nervous when you see like 31,000 trade. Okay, this could be a closing trade. There's another 30,000 trading over here. It could be some type of a spread. But there's some activity in VIX. Okay, and continues to be activity in VIX. And you can sit here and talk about all you want. Like, by the way, the VIX today, it's doing over 500,000 option contracts. That's some serious crap. And again, I don't look at the VIX number because the VIX options are based on these volatility futures and there's movement in there. So look, the bottom line is somebody somewhere, okay, is either nervous about the market's tanking, okay, or they're taking a shot for the market's tanking. Either way you want to put it, right? VIX options really matter, okay, and they're related, of course, to the volatility futures, the VVIX over there. They still scream that pain is ahead. Normally I'd be like, all right, that's in its, it's autonomous, like it's whatever. Volatility says something's coming. But now you have volatility elevating and you have crappy sectors. Okay. I mean, those sectors really are getting smoked. All right. Now, another risk. Okay. Another risk I think you really got to pay attention to, the bond market. The bond market off the Fed announcement, okay, got whacked back a little bit. So it's funny because, at this point, I hadn't even mentioned the Fed at all this week. You want to know why? Who cares? Like I was saying that even on Wednesday night. Who cares about the damn Fed? Nobody cares. Yada, yada, yada. Ain't going to mean a damn thing. The only thing interesting the Fed said is, okay, they don't know what they're going to do in December. He didn't say he wasn't going to cut. He didn't say he was going to cut. He just said, I don't know what I'm going to do in December. I don't even know. It's like a whole nother month away. Like they have no idea what they're going to do in December. And that scared the market. But I think there's more going on than the Fed just saying, like, I don't know what we're going to do. Because the movement that we're seeing here in this 30-year, this is a fairly, significant move. And what people miss about this is about interest rates. In the end, now I'm going to pull up the 10-year, okay? And the 10 years has taken off a little bit. If we start to see, okay, a bit of a trend here in the 10-year, and again, this is the 10-year interest rate, right? And this basically means 3.95, that's right down here. 3.95 is the bottom, okay? Where are we right now? Basically 4.1%. So the 10-year cracks 4.1%. Everybody's talking about lower rates, it's good for mortgages. All of a sudden, boom, we're right back on there. If you start to see, okay, a little bit more, you start to get up to about 4.2%, markets are going to get nervous again. They're going to get very, very nervous. And that's why, like, it's hard right now, okay, to be bullish in some of the sectors that are interest rate sensitive. Specifically, okay, interest rate sensitivity, obviously some of the small caps, which we're back to talking about the Russell. Okay, I'd be a little bit concerned then about KRE, which is a regional bank ETF. Regional bank ETF is already slipping, and a few others. Okay, the financials may not necessarily react positively to interest rates going back up, but that's something you got to actually pay attention to this next week. And I was reiterating that on Wednesday night, and I'm hitting it again today because it's important. People are not paying enough attention to the bond market. And I'm going to tell you why. Because the bond market hasn't done a damn thing for a while. Okay. Bonds, they got a little crazy down here. We touched down to some extreme lows. They rallied back up, and everybody has forgotten the bonds, okay, since what? Like late August. Nobody cares since late August. And here we are. You're going to be trading in November, and all of a sudden, the bonds are actually going to become at issue again. So pay attention. Bonds become a serious concern this next week. You see more sell-side activity in the bonds. Then we're going to be talking about bond vigilantes again. And it's a party, people, and you're invited. Crypto. Let's move on to crypto specifically. Okay. Whenever I talk about crypto, I like to talk about Bitcoin. This has been Mr. Toad's wild ride today. Bitcoin actually touching down, okay, to 109 and change, back up to like 110. It's all over the place. I think it's going to crack at this point. It does not seem to be able to substantiate much of a rally, okay? And of course, I guess some market technicians are going to look at this like it's forming a base of support. Yeah, well, I'm looking at it and saying like, let's just get it on. It's at this point, okay? I was talking about sectors that kind of suck a little bit this week, and crypto is right there, but it rebounded substantially. Okay, on Thursday, crypto was breaking the lower edge of an expected move. Today, it's rebounded, but that rebound is only, okay, in what? Like the last hour or two, okay, of trade. So it is uneasy in there. Again, my opinion, crypto is going to crack. And so just, look for it. All right, let's talk a little about Google, Microsoft, Spiders, XLU. I closed trades profitably in XLU of 55%. I had a in-out spread in Spiders that closed in 2 days. In 2 days, I actually closed that for 30%. For those of you that actually traded some earnings flips with me, okay? He shoots, he scores! Microsoft, 297%, and Google, 203%. Those are the trades that I actually did while live, of course, on Wednesday. So I did the trades live on Wednesday. Everybody got to see them. You didn't even have to be a member of TheoTrade. I did those live, and those two, okay, I hit 2 out of 3. The third one, okay, went out worthless, but whatever. I paid 63 cents for that third one. It went out worthless, making 203% and again 297% respectively on those earnings-based flips. All right, let's go back to the SPX as I do each and every week. Just kind of finalize, what have we seen this week? Well, right now, the marketplace, it's got a little bit more of a bid back under it, right? Okay, rallying back up a little bit, but we're still more than a hop, skip, and a jump. We're definitely higher on the week. I want to clarify that. We're still more than a hop, skip, and a jump, though, off the upper edge of the expected move. So net, okay, the week saw a rally, but I'm going to show you something really interesting. Even though we've seen a bit of a rally, this expected move that we just came out of, come back to here for a second because I think it's that important. The expected move we just came out of, okay, was about $110. That's the expected move for just the week of trade that we're about to end, right? $110 higher, $110 lower. We hit the upper edge, we reverted back down, rallied again, yada, yada, yada. But here's the thing, net, we were higher on the week, okay? Normally, when you are higher on the week, you should see volatility kind of crush back down. There's no Fed announcement coming this next week, is there? Okay, I know that there's government shutdown stuff. Okay, there's lots of politics going on next week, but net, you don't have a Fed. The earnings, okay, we're through the biggest week of earnings already. So I have a good question, okay, for everybody. Why is the expected move still? It's $107. Now that's not set in stone yet. That's not set in stone. That's going to move a little bit. My guess is we come in around 105. Why is the expected move though? Okay, big league with the marketplace that's rallied, and there's not a Fed announcement, and there's not, Amazon and Google and Microsoft and Apple. Okay, we're past those earnings. Why is the expected move so big? Okay, because the marketplace clearly sees something. It's a very, very peculiar time we're in right now. There's nothing else to say other than, you try to handicap like every single move. Okay, what you have to look at right now is step back. Give yourself the 30,000 foot view of this marketplace. Doesn't matter that we're higher right now, okay? We're projecting some risk. Volatility is still like elevated, I mean, today is just a perfect example. Like, holy crap, you have the S&Ps up 40 handles. S&Ps are up 40 handles. We're right back, okay, to early, opening cash session. And then you're up 40 handles, which is 0.6%. It's pretty shocking to even see this. Like, I'm glad I'm recording right now because the volatility is elevated with the marketplace up, okay? Now, that unto itself would give any experienced traders, okay, like a little bit of little angst to come into the weekend. But that coupled with like most of the major market sectors this week, they got smoked, okay? That doesn't leave me like warm and fuzzy. I don't care. And people are like, oh, we're trading at an all-time high. Screw it, man. We're at an all-time high. I got it. Markets never crash from all-time highs. Okay, they don't. Okay, but you got to be concerned at some of the movement that you're seeing in the markets right now. Look, define your risk, okay? Keep it under control out there. And this next week, okay, again, another pivotal week coming. Thanks everybody for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.